As is usual at the start of a month, the latest monthly jobs figures from America will dominate the attention of markets, not forgetting economists, politicians and central bankers. The week will start with the Job Openings and Labour Turnover Survey, or JOLTS, on Tuesday the 5th of December, and that will be followed in quick succession by the ADP Payroll Survey on Wednesday the 6th, and the initial weekly unemployment claims and the Challenger Graham Christmas Job Losses Survey on Thursday the 7th. The week will then end with a big one, the US government's official non-farm payroll survey on Friday the 8th, when the Bureau for Labour Statistics will also release the latest unemployment rate and wage growth numbers, and they'll be for the month of November. By way of comparison, the numbers in October will provide the following benchmarks. In October, America added 150,000 jobs. That was the lowest monthly figure since January 2021. It was also below the 12-month average run rate of 243,000. Besides the headline, also watch for the final revision to the September number of 297,000 and the preliminary revision to October. The final net revision has been downward for every month except one so far in 2023, and that's often seen as a harbinger of a slowdown or even a recession, just as upgrades are usually seen as a positive sign. Meanwhile, the headline unemployment rate was 3.9%. Now that's still near historic lows, but it's now half a percentage point above spring's low of 3.4%. And thanks to the tight labour market, the American average hourly wage grew to $34 exactly, and that was 4.1% higher than the year before. Again, welcome, but a cooling on some of the previous run rates. Now, this all matters because financial markets are now pricing in interest rate cuts for 2024 in the view that it'll be a soft economic landing and a cooling in inflation. Now, that may well be correct, but if it isn't, and the labour market shows signs of a slowdown and a hard landing, then markets might get the rate cuts they crave, but for a less pleasing reason than the one they're currently expecting. Back on the home front, there's a reasonable slate of scheduled corporate announcements in the coming week, with half a dozen FTSE 100 members set to release results, host an analyst meeting, or hold their annual general meeting. Large, mid and small cap names which may be worthy of further research include the following, pending at least any last minute changes of date. Ashtead, Victrex, Moonpig, Marston's, SSP and Gooch and Housego on Tuesday the 5th of December. Weir, TUI, Paragon Banking, Red Northgate and Tritax Eurobox on the 6th. Fraser's, DS Smith, Balfour Beatty, Yellowcake, Future and Mitchells and Butlers on the 7th. And Primark owner Associated British Foods hosts its AGM on Friday the 8th. But the company which could just cause the biggest fuss in the week ahead is Berkeley Group. The high-end house builder is due to report its first half results for the 6 months to the end of October on Friday the 8th of December. The shares stand at a 12-month high, buoyed by management's ambitious plans for housing completions, profits and cash returns for investors by 2025, and also hopes for those interest rate cuts from the Bank of England in 2024. The company provided a trading update in October, and that may have helped sentiment too. Long-standing Chief Executive Rob Perrins reaffirmed the earnings guidance for the year to April 2024, given alongside the full results for fiscal 2023 back in June. And it's by that guidance that these interim results are likely to be judged. In terms of profit, Berkeley expects to make £1.05 billion in total, pre-tax, in the 2024 and 2025 fiscal years combined. Now, management suggested that figure could be slightly front-end loaded, so analysts have put in $540 million for fiscal 24 and £500 million for fiscal 25. Mr. Perrins has also flagged that the 2024 number could be split 50-50 between the first and second halves. So that implies a figure for these interim results of $270 million pre-tax. That compares to £285 million 1 year ago. Berkeley also intends to return £283 million or 266 pence a share to shareholders each and every year through to September 2025 via a mix of dividends and share buybacks. In the first 6 months of this fiscal year, Berkeley has already declared a 59.3 pence a share dividend worth £63 million and £78 million of buybacks on top of that. The next statement on the mix between buybacks and dividend is due in February, and Berkeley's already on record as saying the annual dividend will be at least 66p a share, leaving up to 200 pence a share for buybacks. Behind these headlines, it may be worth checking out the following. First, the trend in volume completions and pricing. In the year to April 2023, Berkeley completed on just over 4,000 dwellings at an average selling price of just over £600,000. In the first half last year, it completed on 2,080 homes at an ASP of £560,000. Also watch here for any updates on reservation rates, which were last described as coming down by around a third on the previous year. Second, look for the trend in operating margin. That sagged a little to 20.3% from 21.6% last year, and analysts expect another modest drop to 20% in this fiscal year. Third, look at cash on the balance sheet. At the end of its last fiscal year, Berkeley had a net cash pile of £410 million. And finally, look at net asset value, or NAV per share. That stood at £31.01 at the end of April 2023. That means Berkeley shares currently trade at around 1.5 times historic NAV, or book value per share. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you again next time.